Welcome to the Mortgage 101 podcast with Anthony and Manley.
Welcome back to the Mortgage 101 podcast with Anthony and Manley, the show that helps you cut through the noise, understand the process, move forward with confidence in any market. Let's get into it. Hey, everybody. Welcome to the Mortgage 101 podcast with Anthony and Manley. Anthony, my friend, how are you doing today?
Aloha, Manley. How are you?
I am doing great. Your hair is tipping another direction today. It's looking very lovely. I like it.
Yeah, it's not
Wind
too
blowing
shitty.
hard there?
What's that?
Is the wind blowing hard there, specific direction? Is that what changed it?
It is. Yeah, these winds, these trade winds are going crazy today. So I figured I'd go with the flow and not go against the grain of the winds.
Let it take you where it wants to go. You've been hard to get a hold of the last couple of days. I was worried your island might be sinking, something to that extent. Everything okay over there?
Yeah, it's just winds, it's just winds and storms, just every day, one day it's sunny and one day it's not. So it's the adventures of an island living, so it's, you get you guys get different seasons, you get summer, winter, autumn, spring, and we get summer with occasional hurricanes and tropical depressions.
There you go. Hey, are the horses and the goats and everybody okay?
Oh yeah, we got stables for that. And I mean,
All right.
they're horses, they're animals, they're used to roughing it out, but they're not too shabby. They're enclosed, and they got trees and other stuff to get them away from the outdoor mess that currently is going on right now.
Gotcha. Well, thinking about you. Hope it stays safe over there. We're not having that kind of weather here. Last week we had the tornadoes we were talking about, but we're doing good so far today. We got beautiful weather here, and it's all bright, sunshiny, warm weather. So here we go. On to the next step. What on earth is happening with these feds and the rate cut? It's rate cut watch time. Is OJ still driving the white Bronco down the highway? And we're all staring at it going, is he going to do something? He's only going 3 miles an hour. Is that what the feds are doing right now? I kind of feel like there's this weird, we're all staring at this white Bronco going down the highway. Are they going to do something? Tell me what your thoughts are, Anthony.
Yeah, obviously it's rate week. The feds are going to be looking at doing something with the rate, and we know that the chances are nil. They're not going to. They're most likely not going to change the rate for June. They're going to keep it the same. I don't think we're going to see the Fed drop the rate until later in the year. And now we're only looking at about 50 basis points. We're not looking at.
Wait, are you telling me we're not cutting the rates? Is the world going to crash and die? Is that what you're saying?
Is not going to crash and burn. The thing is a lot of people misconstrue that the Fed rate is the same as the mortgage rate, and it's not. They're two completely separate facets. They do, fly tandem, but at the end of the day, it's just an outlier. And here's the thing. I mean, the feds are not going to stimulate the economy if it's showing signs of not, being robust, but not decompressing. And so when they're looking at these jobs reports and labor reports and all kinds of other metrics, and it's not showing, red lights, they're not going to dip these rates because, if the consumer spending or the consumer focus is still strong. Do we want to see rates come down? Absolutely. Do we need them to come down? We absolutely need them to come down. We cannot survive in rates in the sixes forever with the cost of living and the cost of goods and the way the economy is as we speak. Now, we hear our grandmas and grandpas talk all the time. Oh, remember our rates were 13. Well, yeah, which your home was like 60 grand. So it's like,
Yeah.
medium house in Hawaii, at least, is over $1 million. So don't give me that cockamamie 13 rate. That's when the cost of living was way different. Inflation was different. The whole world was different. So we can't compare an apple to a banana. We have to compare real world of what's going on now. American people are feeling it in their pocketbooks. They're feeling it in their vacations. They're feeling it in their home purchases. They're having to settle. But that doesn't mean they have to be catatonic and not do anything.
We are time stamping this episode a little bit here because tomorrow is the feds are going to speak. So that's telling people what's going to happen, because a lot of people aren't going to see this till after the fact. But they're going to speak tomorrow. More than likely, they're not going to move rates. And the next time they speak is in September. So that'll be the next opportunity for an actual rate cut, unless something catastrophic would happen and we'd have an emergency meeting, which that's doubtful that's ever going to happen. So everybody's predicting now that we're only going to see a 50 basis point cut possibly this year and continue on to the next year. And interest rates are now feeling that. The bond market is actually relaxing. The tariff conversation is getting limited now at this point, and all that great high level PhD stuff you were talking about, the rate following loosely to the market. That's some yes, some no. At the end of the day, we're all going to live. These rates are going to hang around. We're going to keep grinding down the interest rates. When are we going to see a 5 handle again? I hope within the next 8 to 12 months, but I don't have a crystal ball. That's where we're at.
I mean,
That's
that's
still going to work
at the
out.
end of the day, you do not want to, weigh your purchase based off of a rate. You want to weigh your purchase based off of a need and a necessity, right?
Yep.
And so
Yep.
when you're buying a house, there's a balance between aesthetics and economics, right? You want to buy a house that is going to be comfortable, it's going to be safe, it's going to be what you want, but at the same time, you want to have those metrics of it being economical. And so some people live way beyond their means, some people live way below their means, and some people don't do any means. If anything, our clients can take away from this is just get some information, get some good knowledge, get some education, so that way you're actually making decisions based off of sound information and not out of the unknown. What you don't want to do is not buy a house because you don't know what's going on, or you don't want to buy a house because you're afraid of what's coming. I would much rather hear someone say, I don't want to buy a house because this, and this. Actual specific reasons. That's always the better way, rather than just saying, I'm going to sit this one out because I just don't know.
Yep. That's the deer in the headlights thing again. So we've talked about that. This is all great information. We are retreading this a little bit, but it's very important that people understand, sitting on the sidelines is not in your best interest. Had a great conversation with the first-time home buyer last night that has been out looking a little bit. And they, the commentary was, we think we want to wait a year and see if we can build some more down payment so that we can get our monthly payment lower, a year from now. The downside to that is if you're trying to buy a $300,000 home and it appreciates at anywhere from 6 to 10%, the home's going to be more expensive next year. Possibly the interest rates are going to be lower, possibly not. So what are you gaining by putting that extra money in your pocket? But the big commentary for me was, they're still paying $1,850 a month rent, and they were trying to avoid paying $2,050. So it's a $200 swing. $1,850 a month, that's going out the window. Here we go again. We're taking those $1 bills and chucking them out the window. So you guys all know my stance on this. Jump in as soon as possible, even if it's a tiny bit uncomfortable at first. You will figure out a way to make it work to your own benefit and your long-term gain. Your long-term wealth build that you're creating is way, overpowering a savings of $200 a month from a cash flow. You can figure that out.
Yeah, the slogan, we live within our means, is not just a slogan, it's real. I mean, if you got extra money, 90% of Americans are going to utilize it off of goods and services. Whereas if you implement, okay, here is my dwelling, amount that I need, whether it's rent or a mortgage, you're going to live within those means and make adjustments. So it's important when you talk to your lender, like us, we go over your full debt to income ratio. We don't just look at the house payment, we look at all payments. So that way we could see, okay, What is your, living style like? How much are you used to? And this is the conversations you and I have with our clients. We don't just say, here's your payment and carry on. We look at it and go, okay, let's look at this full picture. Let's look at your portfolio and let's make some right decisions, not comfortable ones, because you're not going to grow and you're not going to go into a better situation if you're not uncomfortable. So people have to learn to get uncomfortable, because comfortable is for our grandparents when they're, sailing in their golden age, or if you're on a cruise, or, if you're sleeping. But, if you're living and breathing and you're wanting this American dream, you want to learn to be uncomfortable.
Anthony, if rates do grind down the way I think they're going to, and we're going to have this over the next, 8 to 12 months, we're going to, if everything stays the way it should, and we don't have any catastrophes, we should see interest rates lower. And we should get ourselves in a position to understand, like, hey, there's an opportunity to refinance. If you bought a home in the last 3 years, we're probably going to be able to see that opportunity that's been sort of like, the carrot on the stick out there that people keep talking about, and we're not able to take a bite of yet. But I really feel like we're getting in that window of opportunity. So what, as a borrower and as somebody that has, a mortgage right now that's in the sevens, what should we be doing right now to get ourselves prepared for an interest rate drop to be able to take advantage of it?
What they don't want to do is prematurely refinance and then tack on an extra 5 to 7,000 when in 6 months they could have got such a bigger bang for their buck. So that's where I really think education comes in, to say, you need to know the baseline, where your mortgage is now, where the market is now, and where it's headed. I have conversations all the time with my clients to say, listen, we can refinance now, but we want to see what that break even rate is, meaning how much is it costing me to refinance and how long is it going to take for me to make up that money, so that way I'm not just throwing money at my mortgage. So if it costs 5 to 7,000 and you're saving 4 to 600 a month, well, that's going to make sense to refinance, because you're going to make that up to where in 12 to 15 months, when the rates do come down, because they will, you're going to have an opportunity to refinance again without having to say, wait a minute, I just threw thousands of dollars on my refi, and now there's an opportunity to refinance again. I'm going to throw another 7,000. That's 15 grand, but I've only saved, five. That's not economical. So a lot of people in our positions, they're just looking for a transaction. They're not looking at the math, and math never lies. So I encourage all of our customers out there, look at the math and make sure the math's mathing, and make sure that what that cost of that refi is, you're going to make that up within that 24-month time. So that way you're setting yourself up not only for short term, but for long term, and you're making the math make sense.
I'm hearing you say hold, and I'm hearing you say hold, just like in Braveheart, when everybody was ready to storm and he kept saying, hold, hold, hold. We need to hold on, do the math, let the math tell you what to do. And as you clearly stated, let's make sure it makes sense and not trying to end up needing to refinance multiple times on accident. So,
Yeah, and a lot of my clients come to me and they go, hey, this refinance shop online is, showing me a 5.99 rate. That's amazing. And then I show them the $9,000 in points and then the other 2,500, like 12,000. I'm like, you're going to have to be in that loan for 7 years to break even. Like, just because you have a 5 in front of that rate. Whereas if you go to like a 6.2, you shave off 50%. Now your break even is in 2 years. And yeah, your payments, higher by 35 bucks, but the math is what makes sense. And so anyone looking to refinance, make sure you have a trusted loan officer that's going to show you this math to say, what is your break even? That is the buzzword, break even. And if they tell you you're break even, or if they don't tell you, that's where you run for the hills, like Braveheart. But you want to, I would say 24 to 36 months is the average for refinances, because we are in an environment where rates are only going to be going down. If we were in an environment a couple of years ago where rates were, 2s and 3s, we were buying that down as far as possible, because we knew that those were unicorn loans, that they're going to sail into the sunset and we're never going to touch them. And our listeners know, I guarantee you 50% of them, if not more, have loans in the twos and they're like, I'm never touching that. So that's not where we're at right now. We are in the complete polar opposite, where historically rates are the highest and they're only coming down. So now more than ever, we have to look at the economics.
So in simple terms, have that great conversation with your loan officer. Decide where that break-even point lies and what that interest rate looks like to get you to that break-even point. And that's called a trigger. And that's when you want to pick up the phone, and your good loan officer is going to have, tools in place that he can set that, and boom, I'll get an email that says, hey, Bill and Jane are ready. We've hit their trigger. Pick up the phone and call them. And then we want to be able to be prepared for that trigger to happen so that we're not waiting around for 3 days for them to decide. That's why you want to have the conversation ahead of time so you can take advantage of the opportunity when it arises. That's all I'll say about that.
Yeah, no, it makes sense. And I had a client last week, they reached out to me and they had a rate at 7%. And they're like, hey, I was about to pull the trigger on this refinance. And I said, okay, well, let me take a look at it. And then I said, send over your mortgage statement. And so I can look at the breakdown. And then I asked them the question of, how long have you been in this mortgage? And they said, well, I've been in it like almost 19 years. And I said, whoa, Baba Louie. I was like, so I pulled out my amortization schedule and then I mirrored it and said, okay, here's an amortization schedule on year 19. And here's an amortization schedule on year 1. So even if I were to drop his rate to 6.2, when you look at that amortization of how much he's going to be paying restarting that amortization versus him having a higher rate, but on year 19, it was literally like $100,000 he would end up paying more. And he was like, why are the 15 other people online not telling me this? And I was like, because you have to know the agenda. If you go to a cheesecake factory and ask them, should I buy a cheesecake or a chocolate cake? They're going to tell you a cheesecake. So the same goes, trust but verify. Know your source and make sure that there's no hidden agenda. And, I'm thankful that you, Manley, and myself, we are on high moral ground to where our fiduciary obligation is to the client. Whether that's the deal gets done or not, we have to fiduciarily obligate them before us. And unfortunately, there's a lot of people, a lot of new lenders, new agents that put themselves before others. So just trust but verify.
I'm not looking for a transaction. I'm looking for a lifelong customer that I can help make good decisions over the life of their loan and the loans that they're going to have in the future, and hopefully their children's children. And those are my moments today that are exciting for me when I'm dealing with grandchildren, and I've helped all the generations between. Super fun. Love that. I'm not trying to make myself sound really old, although I am older. But that's the part that's super good for me. You brought up something really good in that whole conversation that's not everybody focuses on. And I know you stole your amortization table calculator from me. And so what is that? That calculator is pretty nice. And it points out what happens as the years go on. So what was the super bullet point that you need to spit out to us about that scenario? Was that the first 10 years of that mortgage, your principal reduction is not the same as it is the second 10 years or the third 10 years, correct?
In fact, there's one strategy we're doing right now to combat high rates. And what we're doing is we're doing 40-year fixed loans rather than 30-year fixed. So my investor savvy guys are coming to me and they're going, Anthony, tell me what to do. And so I'm looking at it and going, I think we should do a 40-year interest only so we can maximize cash flow, because we know that in the short term, we're going to be refinancing. And when you look at a 40-year loan amortization versus a 30-year loan amortization, it's like a $300 difference for the first year in interest. It's like less than $1,000 the first 3 years as far as interest paid. but it drops your payment by a third because you're stretching it out an extra 10 years, and it gives you the flexibility to have cash flow while you have these high rates. And then I let them know once these rates come down, we can then turn it into a 30-year fixed with a beautiful rate. And now you don't have to wait a year or two to have good cash flow. You can buy it now and continue to have cash flow. And that's been a game changer for a lot of my clients. A lot of my savvy investors already understand that, but a lot of my investors don't.
That's a great investor tool, not necessarily the game for a primary residence or somebody, a first-time home buyer. Doesn't equate to the same thing. But for the investor that's looking for ultimately for cash flow and to protect themselves for a period of time, to get prepared, because these investment properties, they're constantly doing things to the mortgage for multiple reasons, for the tax benefits behind it, for the cash flow benefits behind it. And ultimately, those aren't necessarily the same thing your normal first-time homebuyer primary residence. Not to say that they shouldn't be considering a 40-year term, but doesn't have the same impact to what they're trying to do. Correct?
Yeah, I mean, loans have evolutions to them. When you first buy that, you know, pri primary residence, first time buyer condo or small house, that's going to evolve. It's not going to have the same metrics in 5 years or 10 years or 20 years. And so it's really important that we as professionals hear the story of our clients to say, what's your story and what is your plan? Oh, my plan is to buy a house every 3 years. Okay, great. So we want to set you up to where every 3 years you're picking up a house and you're evolving and those economics are following. So each one has a different set of metrics that are going to make sense for that person, whether it's a primary home, a second home, an investment, a starter home, a forever home. There's a plethora of flavors that our clients bring to us, and it's our job to let them know which flavors match well and which flavors don't.
Great point. Love it. That's why you should talk to a good, well-versed loan officer that's going to walk you through some of that stuff.
Yeah, not only that, but you need to make sure your loan officer, one, their glasses match their shirt. Two, the shirt matches the cord to the microphone. And three, all three of them are the same color. That's when you know your loan officer knows what they're doing.
Spot on. Point taken. Love you, Anthony. You go, girl. Oh, geez. All right. I think on that note, we should take a little break and do some rapid fire from our super duper production manager, Kevin Hansen, who makes all this happen behind the scenes. He's going to fire some questions to us, and we're going to have to figure out what the heck they mean. So is that all right? Let her rip, Tater.
All right. This is the Mortgage 101 rapid fire round. Keep your answers to a minimum. All right. First, fixed or adjustable?
Anthony, you can go first on this one. I'm saying fixed.
I'm saying fixed. It could change in the next 6 months, but fixed for right now.
Fixed. The gap between the two is not enough.
All right.
Correct.
Manley first on this one. FHA or conventional?
Well, I do a lot more conventional, although FHA has its purposes, and sometimes the interest rate is lower, but it's definitely the math will tell you what to do. The math will tell us all the path. So it's a looky-look-see.
Yeah, FHA, doesn't matter if you have a 620 FICO or an 820 FICO, the rate's basically the same. The mortgage insurance basically the same. Conventional, if you have under 720, dude, your rate is skyrocketing, bigger than blood pressure from a donut shop in Belize. So you need to make sure that if you're looking at FHA, that's going to be a low rate, that's going to be a low down payment, and it doesn't matter about your FICO score. If you're going conventional land, better make sure your FICO score is on top notch.
740 or above, or you're going to start looking at it and let the math tell you what to do. Side-by-side comparison is important.
We could do a 620 FICO with conventional, but you could have a $900 a month mortgage insurance and a 9% rate. So they do that to deter people from going conventional if their FICO score is not where it's at.
Certainly not your best choice if you are putting less than 20% down. All right.
All right. I will remind you it's rapid fire. Anthony, buy now or wait?
I say this wait. I mean, all these people buying houses is stupid. They're just, it's a trend and it's going to go away. It's a trend.
I'm calling party foul on this guy. That is exactly the opposite of what we're saying. People, do not listen at this moment. This guy doesn't know what he's too many macadamia nuts.
I just want to keep all the homes for my clients. So everyone else just rents and continue to be economical. No, definitely buy.
Yeah. Bye. All right, next.
All right, Manley, best loan product for first-time home buyers.
Well, that's a very situational question because it depends on credit score, down payment amount, all that. There's a big mixed bag. So I can't say the best loan out there. My clientele is typically a conventional, Freddie Mac type product, but that does not cover everybody. And we kind of already discussed that in the FHA versus, conventional, a traditional conventional, or even a down payment assistance program. So first time home buyers have a wide range of opportunity. And again, math will tell you what to do. Sorry, not a straight answer.
My turn. So basically, you have loans from nothing down to low down to regular down to very high down. And the lower you put down, the higher the rate. Simple as that. And the more you put down, the lower the rate until you put 20% down. A lot of people think, oh, if I put 20% down, I'll have a lower rate. Really, if you put 15% down, you'll have a lower rate. And that's because you have mortgage insurance, which is a risk inhibitor or an insurance policy, so to speak. So I would say get with your mortgage professional and look at the options. This is with down payment assistance, whether it's a state or federal grant. And what does that rate look like? And do I have to be in it for 5 years? And if I sell it or refinance, am I going to have to pay it back? And all the other little things in between.
Yep. A lot of nuances there. Thank you very much.
All right, Anthony, the fastest you've ever closed.
7 days.
Manley.
I've got 9 days under my belt. I don't have 7 days under my belt.
Okay. Manley, the most misunderstood part of the mortgage process.
Money movement and why people have put themselves in bad spots because they move large sums of money. They think that Uncle Jim can give them $50,000 at the last minute. It's not going to be a big deal. And either their loan officer didn't do a good job of explaining to them the detriment of that process that they're talking about, or they didn't listen. So money movement is a huge factor that is an unsung, negative hero in our industry because this industry is known for money laundering. Feds watch that. We have all these compliance things we have to do that really affect the whole loan process. So it has to be documented correctly. Please do not move any large sums of money without talking to your loan officer and letting him create the path of least resistance that's going to make everybody happy. Deal killers.
Anthony.
I would say the insanity that we see, and if I define insanity, doing the same thing over and over again and expecting a different result. And, the problem is, we are creatures of habit and we do things out of habit and redundancy. And if we're exploring a new adventure called homeownership, we have to change our mindset so that way we change our reality. And so that's the only thing I see is a lot of people getting stuck in their old ways and not understanding that they have to look beyond what they're doing in order to explore new opportunities that are there for them. They just need to learn how to not do the same thing that they've been doing in order to get that result.
All right, Anthony, the appraisal gap, deal breaker or manageable?
100% manageable. It's a deal breaker if you're not creative. And what I mean by and if you're not communicative. So appraisal gaps, you can usually see from a mile away. As long as you're being proactive and as long as in the beginning of the transaction, the realtor has looked at that and looked at the comps and said, hey, we got some runway here. Whereas if there's not a lot of runway, it usually is spoken to out loud to the listing agent, to the buyer, to the lenders of, hey, I'm not sure about this appraisal, but we are game to play ball in the event. just letting you know, we're going to knock on your door. So that's usually what happens if, we know it's coming ahead of time, and then we can plan and be proactive against it. Every now and then a curveball will come and go, what is going on here? But that's where we can push it, but it's definitely manageable.
Manley.
I agree with Anthony. You just got to be really over the top and let people know upfront what's going to happen. And do you have the capacity to do this? Are you going to just change your loan to value amount, or is there going to be a massive gap where there's going to be extra cash that's needed and we can't affect the loan to value? So very situational, but manageable.
All right, Manley. One thing you'd change about underwriting.
Well, if it was up to me, I'd have my own giant green stamp that said approved if we just get these things out the door. But there was a bunch of ding-dongs that did that back in the early 2000s, got us into a big mess, and we all saw what happened in 2008. So it's a terrible idea on my part. And the one thing that is changing right now in underwriting is all the AI that's coming into to our underwriting world in the mortgage world, and it's creating faster underwrites, more predictable underwrites, getting us reps and warrants with Fannie and Freddie quicker and sooner, so we can give people, loan approvals within hours, not weeks. So that's what I have to say.
Anthony.
Yeah, I would say the one thing I would change is more implementation of AI, because the less human interpretation, then the less pushback we get. I have found, so it's really important to work with direct retail lenders, because we are working with underwriters that are in our shop. We are not, third party sending it out to someone who's completely disconnected from your lender, and now you're fighting a whole other beast trying to get it underwritten. And so we see a lot of that in the broker world, where no matter what they say, my broker friends out there, because you have brokers and retail lenders, but my broker friends will tell me, that is the biggest pain point, is not having the flexibility and control like someone like Manley and myself have as retail, where everything is condensed in one shop, where we have the most control in the loan transaction.
Control is key, and it can be lost quickly if you go to a broker shop. Not bagging on brokers or anything like that, but that's why I'm where I'm at. We have control. I've been going through a very trying loan for the last week and a half, but we've been underwriting the whole process and been able to make pivots and moves and use our company slogan repeatedly every day, which is "We give a shit," something that Rate prides themselves on, that both me and Anthony work for Rate. We give a shit is real. We were able to, combat some negative appraisal scenarios and get something put together that was very difficult, but it all worked out. We had control of it the whole time.
All right, Anthony. PMI, friend or foe?
I think it's a friend. People hate PMI and they go, it sucks. But back in the 70s, you had to put 20% plus down. You did not have the luxury to be able to put minimum down 0, 3%, 5%. So when people come to me and go, I hate PMI, I go, well, you can obviously put 20% down if you hate PMI. Well, no, I don't want to do that. I'm like, I rather you pay PMI and keep that other 15% in a yield earning fund to make more money. Because again, it's all about the math. Do you want to put, 10,000 down, or do you want to put 70,000 down? So PMI it gets a bad rap, like prunes. Prunes get a bad rap, because it just makes everything go through you. But really, the fiber in it and the antioxidants, yeah, who cares about that? Yeah, prunes are a good deal. I don't know how we got to prunes, but yeah.
I'm not sure how you got there either, but I love it. I'm saying, again, this is a math problem. And in certain points in the history, putting a second mortgage in place with a lower interest rate, sometimes the math would work out. Those are interest-only payments usually, so you're looking at it as if it's money burnt. If you're burning less money on a home equity line of credit to get you that 20% down for that small 10%, whatever. Unfortunately, for the last couple of years, that has not been the case. Mortgage insurance is outpacing that. So it's less money burned, so to speak. it's money out the window, but it also promotes what Anthony's talking about, keeping your other nest egg intact, which is your own cash in your pocket, and the cost to keep that cash in your pocket and to go out with work with a great financial advisor that's earning you anywhere from 7 to 18%. It's going to outpace it every time. Math. The math will tell us what to do. Math is your friend. Talk to somebody that understands a little bit, and they'll help articulate it to you.
All right,
Fact.
Manley. Credit score myth you wish people understood.
Well, I just had this conversation with somebody that was confused about their overall credit card debt as a whole and not focusing on what the monthly payment was really meaning to us from a debt to income ratio standpoint. That's not to say go out and jack your credit cards all up and that overall debt doesn't matter. But what truly matters is, the credit usage, keeping that anywhere from 50% to 30% or less gives you the best credit improvement opportunities. When you get it above 50% and closer to 75%, your credit score gets impacted. And when you get 75% or above, that really gives you a little whack. So those are the things that, that are sort of myths in my book, that people don't understand their credit and their credit card usage and their usage rates comparatively. Monthly payment is important. The credit usage is super important as well, how much you're using of your available credit.
So to play on that, the biggest misconception is it's best to pay your credit cards down to zero every month. That is a myth. Okay. Here's the facts.
Absolutely.
Your credit, with respect to a revolving account, not an installment when it's an automobile or care credit, but a revolving, which is a credit card, has 3 tags on it. First tag is done every month. Second tag is done every month. And third tag is done every single month. And the 3 things they look at is 1, did you pay it on time? 2, what is your usage utilization? And 3, what is your end balance utilization ratio? And they're going to look at these 3 things and go, did you pay it on time? Yes, positive tag. Did you use over or under 50% of the available balance? If you used over, if you have a $1,000 credit card and you use 501 penny, that is over the 50%. That is a negative tag. And then the third one is your end balance utilization ratio, which you want always to be above 1%, but under 20%. And you want to pay your bill 2 days prior to the end of the billing cycle. Because what happens is if you have a $1,000 credit card and you use $400 and then 2 days prior to the end cycle, you pay it down to $20. Now you're only paying interest on $20, not what you used. And now that end balance utilization is going to show over 1%, but under 20. And that is a positive tag. And that's how you get into the 800s club.
One little thing that Anthony just told you there's a little deeper dive on that, is that that cycle date is not the same as your minimum payment due date. You need to actually look at your statement. It will tell you when the cycle is. So he's not saying to pay it 2 days prior to the minimum payment date. He's saying pay it 2 days prior to the cycle date, because that's when they're actually reporting the information. The minimum payment date is different than that. So it's in your best interest. Look that up so you can knock all 3 of those components out of the park that Anthony mentioned, which was great. Deep dive on that. I love that. And pay attention to that date. Look it up. Understand what that date actually is. If your minimum payment's due on the 18th.
Side note, when you look at credit that is in 800s, one consistency is they have nothing but positive tags. When you see credit that's in the 700s, you see a consistency correlation of nothing but positive and neutral tags. And then when you see credit in the 600s, the correlation you see is a blend of positive, neutral, and negative tags. So if you want to get an 800s club, you want all positive tags. If you want to stay in the 700s club, pay that bill to 0, get that neutral tag, and have a good day.
I like the 300 club, but only for bowling.
300 club.
All right, Manley. The worst thing you can do while you're in underwriting.
Go buy a freaking car. Do not do it. Please, for the love of God, Do not go out and buy a car. Do not quit your job. Do not open a new credit card because they offered you a 10% discount on that $500 couch you bought for your new home. Do not do any of that. Do not mess with your credit. Sorry. This is
Don't get married if it's a community property state. So,
if you do, don't tell anybody.
oh, yeah, right. Exactly. Yeah, no. Yeah, I'll jump on that. That is true. Like, and I put it, my processors and my assistants, they put it when they talk to the clients, don't the do's and the don'ts. And yeah, the don't is don't get new credit, don't pull your credit, don't do any of that could jeopardize your loan because it'll change the whole thing. And potentially, I mean, I know sometimes a couple times in my career, I've had to tell people you need to go back to the dealer and you need to hand them the keys and then tell them that you're going to talk to them in a week because that sports car is going to be sitting at that dealer until we close this loan.
Yep.
All right, the last one. Anthony, what still surprises you about the industry?
What surprises me is the amount of misinformation that is poured out on a daily basis, whether it's friends, family, social media, news outlets. There is so much misinformation out there. And it's literally just to get clicks or get views or get clients. And, because how boring would it be if someone just told you facts and the truth? So they have to put spins on it and they have to put sparkles on it and they have to make it seem richer than what it is. And it's like, at the end of the day, good business is bland business. And, a lot of people are out there not in the best interest of the client. So I think that's what surprised me every day when especially when my clients get their credit pulled, when we pull their credit, the bottom feeders is what we call them, the ones who can't have relationships and they chase leads. And so they buy what is called trigger leads and it's in Congress now trying to get passed to be illegal. But when a client, I guarantee you anyone, any listeners listening to this, they've felt the pain when their credit gets pulled and then good Lord, like 10 billion people start calling and texting.
The mosquitoes are...
I have people literally fake like they're on my team, texting them, hey, can you send your W-2 and this to this? And they're like, who's this dude? And so I think that's what surprises me is just the amount of insanity of misinformation and trigger and bad business that is out there still.
Yep. Still exists. I'm going to go on the offensive here and say that's why it's super important to talk to somebody that's a really good loan officer that really has your best interest at heart, is taking care of that fiduciary responsibility that they're supposed to be taking care of. And we're not looking for transactions. I'm not looking to just close the deal. I'm looking to educate. I'm not looking to sell. I'm looking to educate you on the process, let math tell us what we can and can't do, and what fits into your mortgage goals. That's what it's all about for me. And
I got one question though, Manley, and it's the most important question on this podcast. How do you spell fiduciary?
There's something like TARRFRTT, like when we were trying to spell tariffs last week. Okay, we're gonna pull out Expialidocious, all that good stuff. Bring it. Snickerdoodle. Spell it quickly. Yeah.
Fiduciary. Fiduciary.
Fiduciary.
No, I'm good.
Fiduciary responsibility. It's an important thing to think about, and something that I really have taken to heart for my whole career. That I got to be careful what I say. I can't tell people too much. I can't tell our real estate partners too much information about our borrowers, and that's that. So there you have it. But Anthony, this is a good segue into what's the difference between a pre-approval, a pre-qualification, or a really good loan approval like we are.
I mean, it's in steps, right? You can get pre-approval where, it's approval based off of a discussion. It's approval based off of, very little to no paperwork. It's approval based off of, hey, doing an application, but not verifying the accuracy of that information. So that's an approval of like, hey, I'm looking at this and you're approved. Whereas a pre-qualify, now we're digging deep to say, what does this entail? Looking at the taxes, looking at the pay stubs, looking at the assets, looking at the debt to income ratio, looking at the credit, qualifying them beforehand. So that way, when they're walking around, they're not just approved, they're fully qualified. And then you go power bid, which is what we do at Rate, where we actually send it to the underwriter before it even finds a house, which in my opinion is the best, because now you're taking away all the unknowns and it gives you so much more control and power in the offer and in the transaction, because now everything's done other than finding an address. And that's where AI comes in too. We're seeing more and more times it's easier to get that full approval than it was even 3 years ago, where we had to do the long form and we didn't have this, finicity and data verify and all of these automatic algorithms that now do our job for us in a way that instantly we can give them that full approval. So it's definitely big, and it's a big thing in our industry that, especially with listing agents, they know that an approval is only as worth what the paper it's on, unless you have that conversation with that lender to say, what did you do with this approval? Is it fully qualified? Is it a full approval? Give me some meat and potatoes to this, not just say, yeah, they're approved.
Verification, third-party verification, taking it to the next level. And then the highest level is getting that fully underwritten opportunity to help us really put somebody in a position that they can compete against cash offers. It's easy to do, and it can be painful when we ask for all those documents up front, because we want to do our job correctly. We want to verify through documentation what's really going on. And that's where the smart underwrite is really helping us, because some of that's done through AI, that we don't have to get some of those bank statements. We don't have to get some of those pay stubs. So not on every.
And what better to purchase with confidence? Like the last thing, I try to put myself in my client's, position. I want to be able to go out there and look at houses, knowing the payment, knowing that out of pocket, knowing that I'm approved, knowing that everything's been done. And it didn't take weeks. It took like a couple days. It took 2-3 days to get fully verified, fully qualified, to where now there's no more uncertainty. So not only is there no uncertainty for the buyer, but there's no uncertainty for the seller. There's no uncertainty for the professionals involved. And that uncertainty, with it going away, now gives you the leg up compared to other people just going in and saying, here, I'm approved. And I talk to listing agents all the time, and they can tell which lenders just give them fluff and go, oh yeah, they're approved, everything looks good. Or the ones who give detail. Well, we've done verification of income, employment, assets. We looked at this, their salary. They have 6 months of that. So without giving personal information, we can give them an overview that they are well qualified, well vetted out, and fully approved.
Correct. Great job. Appreciate that. Kevin, thank you very much for your rapid fire round that you gave us. Appreciate your help with the show here. Anthony, as always, been wonderful. I hope the weather treats you better than it has, and it stays safe out there for you on your lovely island of Kauai. And appreciate you guys all watching the show. Hopefully there's something educational and informational for you that gave you a little nugget to look into our world a little bit, and found some humor behind it as well, because I think levity is the best answer for most things. And appreciate you all being here. Anthony, thanks again for being here.
Hello, Manley. Always a pleasure, brother.
Thank you very much, and we'll talk again next week. Appreciate you. If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.